Is the U.S. dollar losing its edge? A deep dive into market pressures and political tensions. The U.S. dollar, once a symbol of global stability, is now facing a storm of uncertainty as investors question the Federal Reserve's autonomy and speculate about future rate cuts. This shift has sparked a wave of skepticism that's pushing the greenback to its weakest point in years, a nearly 10% drop against major currencies in 2025 alone. But here's where it gets controversial. The very institution designed to operate independently is now under intense political and economic scrutiny, and that's fueling a trend that could reshape global finance. Let's break this down. Since late March, the short dollar trade, where traders bet the dollar will fall, has dominated foreign exchange markets. According to Commodity Futures Trading Commission data, this strategy has become the default move for many, driven by fears of inflation from tariffs, massive tax cuts, and spending laws. To make matters worse, repeated attempts by the White House to influence the Federal Reserve, including direct pressure on Chair Jerome Powell and attacks on Fed Governor Lisa Cook, have raised red flags about the central bank's independence. And this is the part most people miss. The Fed's ability to act without political interference has historically been its greatest strength. Now, that shield is showing cracks. A Reuters survey of 50 foreign exchange strategists paints a clear picture. Nearly 80%, 39 out of 50, expect net short bets on the dollar to either grow or stay steady by the end of September. Only 11% foresee a reversal, and 0 respondents predict a return to net long positions. Jane Foley, head of FX strategy at Rabank, warns that this one-sided positioning could backfire. If everyone assumes the dollar will weaken, a surprise, like a spike in inflation, could trigger a sharp rebound, she says. That's the risk we're ignoring. So what's next? Interest rate futures suggest markets are already pricing in 2 Fed rate cuts this year and possibly a third in early 2026. Paul Mackel of HSBC sums it up. The dollar's weakness hinges on 2 factors, the Fed's rate-cutting cycle and the erosion of its independence. Meanwhile, President Donald Trump's relentless push for lower rates and his clashes with Fed officials, including his nominee Stephen Miron, who advocates for drastic governance reforms, have turned the central bank into a political battleground. Miron's call for a 1% interest rate and his dismissal of inflationary risks from tariffs have further muddied the waters. Looking ahead, the euro is expected to rise steadily, with forecasts predicting it could hit $1.20 in a year, the highest median target since 2021. But here's the kicker. These predictions rely on the assumption that the Fed will continue its rate-cutting path and that political pressures won't disrupt it. What if they do? Could a president's public demands override the Fed's mandate to stabilize the economy? And what does that mean for the dollar's long-term credibility as a reserve currency? This isn't just about numbers. It's about trust. If markets lose faith in the Fed's independence, the dollar's dominance could face its most significant challenge in decades. As the debate rages on, one question lingers. Do you think political pressure could undermine the Fed's effectiveness? Or is this just a temporary blip? Share your thoughts in the comments below.